Hello everybody, this is Zaheer Anwari from the Traders Cosmos. Can you all hear me okay? If you can just give me a quick thumbs up, let me know that you can see my, let me just change my screen. Thank you, Ron. Thank you, John. Okay, brilliant. Danny, brilliant. Okay, thank you, excellent. Good day, right, thank you all very much for taking the time out to be at today's webinar. My name is Zaheer Anwari. I am the founder of the Traders Cosmos. Now, today's webinar is basically all about how to create a watch list. Of course, I haven't really met you guys in person, and I've not really had a conversation with pretty much any of you. I think you're new. I think a lot of new guys to today's webinar, which is great. If you are familiar with my style of trading, it's very much long-term, okay? So I am what is called a trend trader. So I'm looking for long-term trends that establish themselves over, well, days, weeks, and potentially months. And so because of that kind of approach, it tends to be a lot slower, a lot more relaxed, a lot less time-consuming, very much stress-free, but initially quite slow when it comes to making profits, but over the long term, these profits grow exponentially. My style is very much in line with the turtle traders. So if you are familiar with the turtle traders, then you know that they were effectively what we call trend traders. So today's webinar is basically how to build a watch list based on trends. We'll go through that. If you do have any questions, please type them in the box and I'll go through them at the end of the session. Okay, so let's get into this. What you can see in front of you is what is typically a chart setup of mine. So in the top left corner, you have my watch list. So it's quite an extensive watch list. So we've got the Aussie dollar at the top, going all the way down to the South African rand, Japanese yen. So I've got a pretty extensive watch list. And then in the top right corner, I've got the monthly time frame. In the bottom left, I've got the weekly, and in the bottom right, I've got the daily. Now, what I'm looking for is correlation between all three time frames. So when all three are in alignments, that for me is potentially a good entry or a good trade or a good pair to be trading. So the monthly and the weekly are what I use to establish trend direction. And the daily is where I really check for bias and also for entry and where I manage my stops. And notice the last point where I manage my stops. That's a crucial element to my trading. A lot of traders may use the daily, may even use the monthly and weekly in some aspect, but when it actually comes to managing their stops, they then tend to go down to a lower time frame. And because of the intraday noise that's involved with lower time frame trading, traders get stopped out a lot quicker. So by managing my stops on the daily time frame, I'm actually eliminating that intraday noise, and it tends to be a much smoother ride. Okay, so let's start with the monthly time frame. Now, once again, what you'll notice is that my charts are very clean. It's not cluttered with a load of moving averages, although I do use them, and I'll explain how I use them. It's not overly cluttered. There are no sub-chart indicators. I very rarely use things like stochastic and RSI, purely because price action tells me everything I need to know. And an indicator, such as stochastic or an RSI, is effectively a mathematical formula that incorporates some element of time, whether it's the high, the open, the low, the close, some element of time, puts that into the formula, and that's what creates the sub-chart indicator. So what does that tell us? That tells us that price always comes first. So a solid understanding of price action is very, very important. So what you'll notice on the monthly chart are these pink lines. Now, what these pink lines represent are effectively the high. So you can see where it says PH, PH, PH. So effectively the high and the low of previous years. So those are the major areas of support and resistance that I'm looking at, the high and the low of previous years. So this pink line high where it says 1.0601, this is the high of 2013 as we are in 2014. This is the high of 2013. This is the low of 2013. And so on and so forth. This will be the high of 2012. This will be the low of 2012. The high of 2011, the low of 2011. so on and so forth. Now, to keep this even simpler, I only take the previous 2 years into consideration. So I'm really looking at the high and the low of 2013 and 2012. The ones that go beyond that tend to become weaker in strength, and it just ends up being far more complicated than it needs to be. So beyond that, I'm then looking at round numbers. Okay, so the high and the low of the last 2 years are previous areas of support and resistance. And then beyond that, I'm then looking at round numbers, 0.8, 0.7, 0.6. So round numbers tend to be every 1,000 pips. So how do I incorporate this into making a watch list? So what I'm looking for is clean areas of trend. Currently, if we look at the Aussie dollar, so what I'm looking at is the first pair on my watch list, which is the Aussie dollar US dollar. We can see that the Aussie dollar US dollar is stuck between the low of 2012, which is acting as an area of resistance, and the low of 2013, which is acting as an area of support. So what we've got is also a prolonged area of consolidation. So if you look at the bottom here, we're really looking at sort of mid 2013 all the way through to September of this year. So, this area of consolidation is over a year now. So it's during this period that trend traders stay well out of the market. What we're looking for is a breakout of this consolidation area. And what we can see last month, we had a big drop in price. So this is where the bears really took control of the market. It closed beyond the pink line low of 2013. So this is now acting as an area of resistance. However, it has not broken beyond this low point. So as of Sunday, what I do is I simply look at the monthly chart and I look for areas of support and resistance. If price is stuck between these areas of support and resistance, I simply do nothing, but I keep an eye on this because I'm looking at how far price action is away from breaking out. So we can see that price is actually quite close to breaking below this level. So this is now on my watch list. If it breaks below this level, I would then want to see price target 0.8, 0.7, 0.6, so on and so forth. Remember, it's not guaranteed, but what's happened in the past is a good indication of future price action. So we can see that price has reached lows of 0.6 and even lower than that, going back to sort of 2001. So there is potential for a bear trend to really establish itself. Okay, so that's how I use the monthly chart. Major areas of support and resistance. So the Aussie dollar US dollar is on the watch list. I then go down to the weekly time frame to see where price is in relation to the weekly 200 moving average. Now the weekly 200 moving average also acts as a major area of support and resistance. So as price is now trading below the weekly 200 moving average, this is now of no concern. So I do not need to worry about the weekly 200 moving average being a support level where price is going to bounce off. So the weekly is in alignment with the monthly in the sense that there are no major areas of support and resistance beyond this pivot being broken. If we go down to the daily, now the daily has the daily 200 moving average on the chart. How do I use the daily 200 moving average? Well, at the beginning of the webinar, I mentioned that the daily 200 moving average gives me a bias in price action. What that means is that when price is trading below the daily 200 moving average, I look for shorting opportunities. And when price is trading above the daily 200 moving average, I look for long opportunities. So my bias is bearish below and bullish above. Okay, so now taking all three of these into consideration, what we have is the monthly price has broken below the pink line, but it hasn't broken beyond the support level. On the weekly, we are trading below the weekly 200 moving average. So this is no area of concern at the moment. And on the daily, we're trading below the daily 200 moving average. And we're trading below the figure 0.9, of course, on all three time frames. So what this is telling us is the monthly, weekly, and daily are all in alignment. As you can see over this week, what we had is indecision in the market. So we've had this real move down, like an Elliott wave 3 of sorts, very fast moving wave. Pullbacks have been short-lived, 1 or 2 bars continuation. What we do have is a little bit of indecision. Now this indecision, of course, is because of that support level that we had mentioned earlier, the pivot support right here. So what you've got is the bulls and the bears really sort of battling it out without really any clear idea of what it wants to do next. In addition, we've got NFP out tomorrow. So NFP does tend to create a little bit noise in the market, before a trend direction is established. By the way, nothing more than noise. When NFP is out, I personally stay out of the market, definitely from the Thursday, but potentially from the Wednesday as well. So Wednesday, Thursday, Friday, there's no trading. So as you can see, plenty of indecision at the moment. A break and a close below here, and I will look to enter the market. So this is how I make my watch list on the Sunday, looking for alignment between monthly, weekly, and daily. Right, I'm just going to check for questions. Okay, there's no questions at the moment. Could you all just give me a little heads up to let me know that that makes perfect sense? Thank you, Danny. Okay, brilliant. Yep. Okay, brilliant. Okay, excellent. Thank you. All positive. Right, so with that same sort of understanding, what I'm going to do is just go through various charts and incorporate all of that, all of what we've just gone through together. Okay, so Aussie dollar, Canadian dollar, that's the next on the watch list. And by the way, guys, when I look at the monthly and I've got my support and resistance, it doesn't take long really to sort of get a routine to this, and there comes a point where literally you can look at a chart for anywhere from like 3 to 5 seconds and know instantly whether that is something that is tradable or not. If you find yourself staring at a chart for too long, then what that means is that you're looking for something that may potentially not be there. So trading has to be, in a way, quite instantaneous with the right knowledge. Okay, so I've just got a question that's come through. If you don't trade on Wednesday, Thursday, Friday, how do you manage your position? Okay, that's a good question. Basically, I have my stops in play. I don't take, from the Wednesday, Thursday, Friday, I don't take any new trades. My trades that are in play, I don't manage, I don't mess around with the stops. I don't tighten them. I leave my stops where they are. So my stops can be anywhere from like 300-400 pips away from price action, potentially. And usually NFP is just a spike in the long-term trend. So my stops tend to stay exactly where they are. I just don't open any new positions unless it's a compound that my strategy has signaled. I hope that makes sense, Ron. Okay, so let's go back to, you're welcome. Right, let's go back to the Aussie dollar, Canadian dollar. So what are we looking at? Well, we've got the high of 2013. We've got the low of 2013. So the low of 2013 is acting as a support level. We've then got the figure 0.9, 0.8, and then 0.7. So these are the potential levels of support that we can be targeting. We are also below the major figure of 1. So this is looking quite interesting. What we're looking for is further weakness. If we go to the weekly, we're below the weekly 200 moving average. So nothing to really be worried about. This is an area of resistance. And the next major area of support will be that pivot level around there, potentially that pivot level here, certainly that pivot level here. And if we go to the daily 200 moving average, what we've got is price trading below the daily 200 moving average. So everything in terms of the monthly, the weekly, and daily, what we've got is price in alignment here with space to move to future support levels. So if price breaks and closes below this pivot point, this will mean a potential continuation of the downtrend, and we can see that price is quite clearly in this downtrend. Again, quite a fast-moving downtrend. Look at how much light work it made off the daily 200 moving average. The daily 200 moving average is also an area of support and resistance, and it's gone straight through it, not like it did here. So it's broken straight through it, suggesting that future support levels will also get taken out without really any issues. Okay, remember, after every move, we tend to see some kind of correction, breather in price, and that's all this is for now. What we're looking for is a break and a close below this level. A break and a close, and we should see further weakness to at least this pivot level, which is, you know, a good few hundred pips away. So the Aussie dollar, Canadian dollar should be on your watch list. Okay. No, it is a good question. One of the questions that's just come through, which is why don't you use the 100 moving average? I tend to use the 200, the 50, and the 21. Okay, they're the three main moving averages that I use. When I'm looking for my Sunday analysis and I'm looking to create a watch list, I use mainly the 200 moving averages to tell me whether I'm in a bullish market or a bearish market. I can then use further moving averages such as the 50 to add further confluence of events. So for example, if the 50 has crossed over the 200, then, again, that suggests further weakness. So if I was to add the 50 moving average on here, let's just do that for example. Go into the back end, apply. Okay, and I'm going to change this to 50. Okay, so what we can see is that price hasn't broken below the 50 moving, the 50 moving average hasn't broken below the 200 moving average as yet. Now, there's two ways that you can attack this scenario. The first scenario is to be conservative and wait for the 50 to break below the 200 before you start looking to trade. So you've got that added confirmation that you're in a downtrend. Or the more aggressive approach is to trade based purely on price action, because remember, price comes before the moving averages. So I'm focused purely on price action. And if you do decide to trade this, then half your risk. So if you haven't got a full confluence of events, you can risk 2% per trade, for example. And if you are still waiting for the 50 to cross below the 200, then you can take the trade based purely on price action, but take it at 1% risk. So you can adjust your risk accordingly depending on whether you're aggressive or conservative, whether you've got full confluence of events or partial confluence of events. It really depends on the style of trader that you are. I don't generally always wait for the 50 moving average. I basically play around with my risk according to what the chart is telling me, because price always comes first. Okay, I'll leave the 50 on there just for visual purposes. Okay, let's look at the Aussie dollar Swiss franc. Okay, Aussie dollar Swiss franc. Right, what we can see is that price found an area of support at the pink line low. It's bounced to the upside, and now it's going through a bit of a breather area based on this pivot level here. So it's basically stuck between resistance and support. If we go to the weekly time frame, we can see that price is also just kind of going through a sideways movement. There's not really a clean trend direction on here. And if we go to the daily time frame, now this is one of the main reasons why I'll be standing aside, is because remember, the daily 200 moving average gives me the bias in price action. So price is heading down, but it's finding support at the daily 200 moving average. So I'm not going to start shorting this until price has broken below the daily 200 moving average. Now, I know what people are thinking. What people are thinking is that they're missing out on that by waiting. I'm missing out on potential profit. Why haven't I started trading here and taken this? Now, remember, first of all, in hindsight, charts always look interesting. So looking at this now, yeah, I should have jumped in here and I should have traded it. But while this was developing, this was still not a high probability setup based on the confluence of events that I'm looking at. Because if I'm looking to go short, I want to break the daily 200 moving average. So what this requires is a level of patience. However, guys, remember the size of my watch list. I've got an extensive watch list of 60, 70 pairs. While this is setting up, I've got other pairs that are trending. I've got other pairs that are much better set up to this, and I am trading those and taking profit. So remember, a good trader has a good watch list and knows how to move from a set of trending pairs to another, and knows also how to apply patience. Patience is fundamental to trading. Okay, so to give you an example of that, I'm going to go to the euro dollar because I know people trade the euro dollar, and the euro dollar is not something that I'm obsessed with, but it is something that I trade when it does set up. okay, when it does set up. Not always, but when it does set up. So let's have a look. What we've had was the monthly finding an area of resistance at the high of last year, which is also correlated to the round number of 1.4. So this is a good example of how price moves between round numbers. It bounced off 1.4 and it's headed towards 1.3. Now look at where we are. We're below the pink line of 2013. So this is now a resistance level. As we're below that resistance level and we're below 1.3, I would like to see price target 1.2, which is also the low of 2012. So we've got a good 700-800 pips for price to trend. Okay, so this should now be on your watch list. Let's have a look at what's going on the weekly time frame. On the weekly time frame, we're trading below the weekly 200 moving average, and you can see consistent red bars. So price is weakening. You want to be going in the direction of the trend, and as for now, the trend is very much down. If we go to the daily time frame, we are below the daily 200 moving average. The 50 has crossed over the 200. And this, guys, is a trend that I have been in for quite some time and taken very good profit. I've had multiple positions running on here, all compounded. And the euro dollar, excuse me, I can't speak today. The euro dollar has handed out very, very good profit. So while I'm waiting, say, for the Aussie dollar Swiss franc to set up, I'm going to stick with the euro dollar because the euro dollar is giving profit. Now look at what's happening. Currently, we've had very good profit handed out in the last few days, but as of the last couple of days, we've just had indecision. A, because this is a build up to NFP, and B, it's because it's just broken major support, which becomes resistance. So usually there tends to be some kind of retest or indecision before a continuation. This is just natural market movement. So the euro dollar should be on your watch list because the monthly, the weekly, and the daily are all in alignment. Okay, let's have a look at the yen. So the dollar yen. I'm currently looking at pairs that I'm either trading or are looking interesting for potential trades. So let's have a look at the dollar yen. Now the dollar yen handed out very, very good profit in 2012, 2013, and you can see that with this big bull trend. Now after every move, price goes through an area of consolidation, and you can see from this trend compared to this trend, this is very much sideways. So we took good profit, and this is where we stay out of the market, and that's also because of the figure 100, which is more of a resistance, which is more of a sort of comfort area, major round number. Price came back, retested it. We had an engulfing candle. Price came back, retested it. We've had a bounce to the upside. Price last month, being September, broke through the pink line high. So that's the high of 2013, which became a support level and continued its climb. And it's now currently finding resistance at 110. Again, a round number. So it's broken 100, it's now at 110. So it's bouncing between round numbers. If it breaks 110, we want it to go to 120 and potentially 130, 140, and so on. So looking at the monthly, price is looking interesting, but it's currently at 110 support. If you look at the weekly, we're above the weekly 200 moving average. When price broke above this pivot, this is where I started entering, and I've got positions running on here. So when price broke above the 105, 106 pivot of 2013, this is when I entered the market and I've got positions running. If we go to the daily 200 move, if we go to the daily chart, we can see this is that prolonged area of consolidation in a lot more detail, very messy. Price found an area of support of the daily 200 moving average, and this is where the bulls really came in strong. When price broke this pivot around this level here, this is where I entered the market, and this is where I've got positions running. Now, okay, what we've got is a pullback, and that's because of the 110 figure. I've got stops in play and I've got profit locked in. If my stops get triggered, that's part and parcel of trading. But for now, this is nothing more than a breather in an uptrend. So what we've got is price bouncing between this support level and the resistance of 110. So we've got the pivot support here and we've got the resistance here. What we're looking for is price to correct itself, break up and break out, where then I can further compound. So if price breaks above this high, I can compound further. And you guys can then start entering the market and looking for 120. Okay, again, if this is the style of trading you want to adopt, If you want to adopt a trend trading style of trading as opposed to day trading, scalping, something which is slower, something which is less stress-free, something that can be adapted around your 9 to 5, then if this is the style of trading you're looking for, then this is what you do. You wait for this pivot high to be broken. This will break 110. You can then start entering the market. So what we have is the monthly, weekly, daily, all in alignment, but we've got figure 110 resistance. When this becomes support, we can start entering the market. Okay, I can see a few questions coming through, so I'm just going to have a look at the questions. Okay, Zishan asks, where can we get the previous high? Okay, so what I'm assuming is the pink line. That is a tool that comes with Advanced Get. So the software that I'm using is eSignals Advanced Get, and that is the tool that comes with it. So what you can notice is that I have good software that does a lot of the work for me. You don't want to be spending time drawing in support and resistance. The software automatically plots these levels for me. So it's a tool within Advanced Get. When you are in the trade, what signal you take to get out? Okay, I have several ways of managing my stops. I never close off positions manually or emotionally. I basically have a system that I use. It's very mechanical. It does incorporate mental stop losses sometimes. So mental stop losses are for the more experienced trader. It does take a little bit of discipline. The turtle traders use mental stop losses. So there is a system that I use, and that all depends on the kind of wave. So, you know, is it a fast moving wave? Is it a slower moving wave? It also depends on the strategy that I'm using. Is it a breakout strategy? Is it a pullback strategy? So there is a mechanical and well thought out approach. And it is a good question, because ultimately, guys, in trading, the exit is far more important than the entry. You know, people seem to be able to find entries all the time, breakouts, pullbacks, you know, lower time frame, 4 hour, 1 hour, you know, it's very easy to get in on an entry. The key to making money, and that's what trading's about. Trading's not about winning. Trading's about money. That's what we want. It's not about getting in and beating the market on a couple of trades and, you know, getting happy about it. No, it's about making money and consistent money, and money that you're then able to fund and build a lifestyle on. So it's not about winning, it's about profit. And so when it comes down to that, when you have that thought process, it's not about how many winners you have, it's about how large your winners are. That's far more important. I could have a portfolio success rate of 30%, but my 30% brings me a lot of money. So it's not about how large your winner, how many winners you have. It's about how large they are, and that all comes down to having a very, very good exit management system. If you guys want to know more about my exit management systems, then please get in touch and we can talk about that in a little bit more detail. But it's not the kind of information that I really give away too easily. So please get in touch with me and we can talk about that. Okay, there aren't any more questions for now, so I'm going to look at a couple more currencies. You're welcome, Ralph. If there are any pairs that you'd want me to look at, then please just put them in the box. Right, let's have a look at the New Zealand dollar. Okay, I'll have a look at the Aussie Dollar Yen. So the New Zealand dollar, Aussie dollar, and the Aussie dollar, US dollar, they're both sort of correlated because of geographical location. So whatever the Aussie dollar is doing, you'd really expect the New Zealand dollar to be doing something similar. So if we look at the monthly chart, we can see that we had a very steep drop in price, just like the Aussie dollar. So we had a tram tracks formation at the 2013 high, and price dropped very rapidly in 3 months, and it's now retesting the low of last year. It's below the figure 0.8. So if price breaks below this low level, then we should see price attack this low. If it breaks below this low, so only the last 2 years, I then look at round numbers, 0.7, 0.6, 0.5. So if it takes out this whole level from this pink line to 0.75, if it takes out this whole level here, then we should see further weakness and a very clean trend establish itself. And if you look in the past, it has done that. nice bear trend followed by, well, a nice bull trend, a little bit messy, but the point is that these lows have been reached before. So we can see this potentially happen again. If we look at the weekly, we're trading below the weekly 200 moving average. And if we look at the daily, we're trading below the daily 200 moving average. 50 has crossed over the 200. So we actually have a very good setup here in terms of all three charts being correlated. But what you can see is a little bit of indecision, a bit messy, and that is because price is facing this support level. And so what you've got is intraday traders really trying to push price up. When the trend comes into play and if it breaks through this level, then we should see further weakness. So I have got positions running on the New Zealand dollar, US dollar that are in profit. I will compound if it breaks below this level here. So the New Zealand dollar, US dollar is on my watch list. Again, all three in correlation. They're all in alignment. We're just waiting for this support level to be broken and for it to become resistance. Okay, that's a good question. Basically being asked, what does red and green mean? It basically means that today's been a bearish day. So if it's red, it's been a bearish day. And if it's green, it's been a bullish day. So it's just really telling you whether price has moved further down or further up today, not overall. Okay, you're welcome. Right, let's have a look at the Aussie Dollar Yen. Okay, so looking at the monthly chart, we can see that the Aussie Dollar Yen is just basically very messy. So again, this is not something that I'm really interested in trading because you can see the Euro dollar, you can see the Aussie dollar, US dollar, the New Zealand dollar, US dollar, much better trends in play on other currencies. This is quite messy at the moment. But what we do have is the 100 figure acting as resistance, and we've had weakness. If we go to the weekly, price is heading down, but we're above the weekly 200 moving average. Again, it's more of an area of consolidation. And if we go to the daily, well, we've got price finding support at the daily 200 moving average. So what you can see is the monthly showing weakness, but you've got the weekly and the daily that are facing major areas of support. So the first thing I'm waiting for, if I'm looking to take shorting opportunities, is for the daily 200 moving average to be broken. So if this breaks the daily 200 moving average and then it starts breaking these support levels here, then I will look to start shorting this. The weekly 200 moving average will act as an area of support. If it breaks this, then we should see weakness to the pink line. If the weekly 200 moving average gets broken, it will also break the low of last year, and then we should start seeing 80, 70, and so on being targeted. Okay, so the Aussie dollar Japanese yen is not a very good trend, a very good pair to be in, or trending very well at all. I've just seen the South African rand being mentioned. Okay, so the South African rand is not the worst looking. It's actually it's looking quite interesting. So what we've got is the high of 2013 acting as an area of resistance support. You can see the price came down, indecision, bounced to the upside last month. It's now at that pivot. So very similar to the Aussie dollar, US dollar, in that it's now finding pivot resistance. What we're looking for is, price to break and close above this. And then we should start seeing the round numbers being attacked. So round number of 12, which is not too far away, probably about 400 pips away by the time it gets broken. Then 13, 14. So if you do like to trade exotics, then the South African rand is on your watch list. And you can see that it can trend. Pullbacks tend to be quite deep, so you may want to have wider stop losses. But you can see the South African rand does trend for an exotic currency. We're above the weekly 200 moving average. Again, indecision. You can see there's like a doji being formed so far, and that's because of this resistance level. Now, guys, remember, a doji doesn't mean a reversal, and that's where people go wrong. A doji doesn't mean reversal. A doji means indecision. The market doesn't know what to do next. If you have a look at its example here, if I just expand this, you can see that we've got a doji here. So we've got green bars, green bars, green bars, and then we've got a doji. And you can see that price then continued. So a doji doesn't necessarily mean a reversal, it just means indecision. Okay, here we've got a reversal in price and we've got indecision. We've had indecision, and then a couple of spinning tops, and then price came down. So these kind of changes happen at areas of significance. So this was potentially, let's have a look. if I compress price action, we can see that this level here was a strong area of resistance in the past. And that's why we had indecision and then a bounce to the downside. But if these sort of doji spinning tops, if they happen at insignificant levels, more often than not, it means a continuation of the trend than a reversal. It just means that at that particular month, day or week, there was just indecision and the market didn't know what to do. So don't get overly obsessed with candlesticks. Learn how to use candlesticks. Okay. Well, I'll go through one more and then I'll call it a day. Let's have a look at the pound Swiss franc, because the pound Swiss franc is looking interesting. You're welcome. Pound New Zealand dollar. Okay, I'll have a look at that. Okay, pound Swiss franc. What do we have? Well, what we can see is that price is trading. If I just expand this, we can see that price is trading above the pink line high of 2013. So this is a support level. And it's stuck between the resistance, which is the high of 2012. So price is just stuck between support and resistance. So for now, there's no clear trend direction on this. However, we can see that the trend is creeping up. So ideally, what we'd like to see is price break above this high and continue the bull trend to 1.6, 1.7, and so on. So for now, trend traders will be standing aside on this. But if we do get a break above this level, then we should see further strength. And you can see that we've had highs of 2.5 in the past. So potentially, we could see good movement. Remember, guys, the longer the consolidation, the bigger the breakout. The longer the consolidation, the bigger the breakout. This has been consolidating since 2011. This has just been a sideways movement. Okay, there have been mini trends in between, but nothing compared to trends in the past. So this is not really something that you want to be too caught up in. If it does break out, then you want to see price really move to these levels. And that is where we will see a trend. And that's where we will then put compounding into practice. And compounding is powerful when you know how to use it. Okay, weekly chart. We're above the weekly 200 moving average. We need to break above this level here. And the daily chart, we're above the daily 200 moving average. The 50 is above the daily 200 moving average. But as you can see, as of this week, we've had indecision and then weakness today. So this is really where the day traders are potentially trying to find the top of a trend and push price down. Now, they may be correct and price could weaken, but the long-term trend is up, and that's the direction we want to be going in. So we really want to be standing aside until we get a breakout to the upside. Excuse me. Okay, question is, what attention do you give to fundamentals? Guys, technical analysis tells me everything I need to know. Okay, technical analysis tells me everything that I need to know. Things like NFP, I just stay out of the market. There's news coming out all the time, every minute of the day. You have to remember that the big dogs, the institutions, the hedge funds, they get the news well before us. So by the time we actually see price move, fundamentals have already been incorporated into price action. So I would say to you guys, don't waste your time. When it comes to Forex, don't waste your time with fundamentals. Technical analysis tells you everything you need to know. Now, when I trade stocks, that might be a different ball game. I may take fundamentals into consideration when I'm trading stocks. But with foreign exchange, you don't need to. Okay, I think someone's written the UN. The Chinese, is that the Chinese currency? If I be honest with you, I don't even really look at that. But let's have a look at the Chinese yen. And if you look at the monthly, you can see why. Okay, the trend is down, but I mean, it's not a chart that I particularly want to be involved in. It just doesn't look good. Yeah. And, you know, with the other currencies that I have on my watch list, it's not something that I'm particularly interested in. But if you do want to trade this, then you are below the weekly 200 moving average, and you are below the daily 200 moving average, and below the 50. So the charts are correlated. If it breaks out of this pink line low on the monthly chart, then you can look to short this. Okay, last one is the pound. Someone has put that up, the cable. Okay, so what we can see is that price was in a long-term consolidation going back all the way to 2009, and that's because of this big drop in price. After every big move, price has to correct itself. So earlier this year, we got a little bit excited because price broke above the figure 1.7 and it broke above the high of this bar, which was around 1.7043. So price broke above the range. You can see that here. But the breakout was short-lived, and you can see that price reversed. Now, that is part and parcel of trading. Nothing in trading is guaranteed. That's why you always want to keep your risk small. What I was targeting on this breakout was a break to 1.8, 1.9, and 2. However, and most likely due to what was happening with Scotland, the pound has weakened. Now, what does that mean? Price is weakened to the weekly 200 moving average. It's now finding an area of support and a little bit of indecision. We've now had further weakness this week. If price breaks below the weekly 200 moving average, then that will mean that we have a bearish bias on the weekly chart. So we can start potentially looking for shorting opportunities. If we go to the daily time frame, we are actually below the daily 200 moving average, and the 50 moving average has crossed below. So if price breaks this pivot and the figure 1.6 and the weekly 200 moving average, then potentially we can start looking for shorting opportunities. The target will be around 1.5, which is the low of 2013 and the low of 2012. So we've got a cluster with the figure 1.5. So there's a whole cluster support zone around here. So we have got space to move, but we need to make sure that we lock in good profits and our targets are well placed before this support level. Okay. Price reversed at supply. Yeah, I don't really use supply and demand for currencies. If that is your approach and if that works, that's fine. I don't use supply and demand. For me, that was just purely a failure at support level, and price has reversed. Do you use support and resistance? Yeah, I think I've just really covered that. Support and resistance being the pink lines, and the round numbers 1.5, 1.6. So I tend to look at I look at a much bigger picture as opposed to looking at too many support and resistance levels. I look at a much bigger picture, and so what I use are the highs and lows of previous years, and then I look at round numbers, which are every 1,000 pips. The answer: do I look at fib levels? Okay, that's a good question. Again, fib levels have their place. I look at fib levels purely for pullbacks. So as an example, if I wanted to look at this, I would take my Fibonacci tool, yeah, and I would take it from the low to the high, and I would look at the fact that price is at 0.382 and 0.5 and think, okay, that's potentially where price could bounce to the upside. That's about as far as where my use of Fibonacci goes. I don't look at it for an entry. I don't look at it for target levels, like, you know, Fibonacci extension. I don't really get too obsessed with Fibonacci levels. Again, if it works for you, then that's fine. What I found is that Fibonacci retracement is good for pullback levels, but when it comes to target levels, I prefer to use the round numbers, so 1.8 and 1.9 and 2, as in this case. Okay, yeah, okay, thank you. I've got 2 minutes, I've been told, so I'm going to get off. Just making sure I've answered all your questions. Yes, Javier, I use the same strategy in stocks. Of course, we need to be a little bit more careful with stocks because we do have things like gapping and, sometimes charts aren't as smooth as other charts, and there's a much wider range. The way I get around that is by having good software. So I use MetaStock to scan the market, and I use the indices, so the Dow, the NASDAQ, and the S&P. I use the indices to guide me. I don't trade the indices. I simply use them as a guidance to tell me what's going on. So at the moment, the indices are basically they're a bit ranging, consolidating. So the stocks are all kind of pulling back. So I wouldn't really be trading stocks at the moment because the trends are in Forex. However, if I just bring up one chart quickly, which is the Marriott, MAR, and you can see that when foreign exchange was quiet earlier this year, the Marriott, which is one of the stocks I have been trading, has handed out very good profit. Okay, we had the Marriott, and we've also had Southwest Airlines, which is LUV. So you can see that I've been trading LUV. That's moved from around 14 all the way to about 34. So it's knowing which are the good trends to be trading. Okay, I'm going to call it a day there. I'm just going to quickly refer you guys to my website, which is thetraderscosmos.com. If you go to blogs and then trading contributions, it will take you to this page, and that will give you links to all the articles that I've got online. So I write for the Huffington Post. My FX Street archives are all on here, and I also write for FX Trader magazine. Guys, if you want to learn how to do this properly, if you've got the time and the money to invest into trading and want to learn this properly, please get in touch and we can talk about this in more detail. Okay, please contact me through the website. Brilliant. Thank you all very much for your time. I hope you found that useful, and any questions, please get in touch. Else, have a good day and see you on the next webinar. Take care, guys. Bye-bye.